For decades, China's economy was a sure bet, an unstoppable growth engine. But lately, you've probably heard the headlines. That engine is starting to sputter. So what's really going on? Let me tell you, this isn't just a temporary dip. It's something much deeper. Okay, let's just look at the raw numbers here because they tell a pretty dramatic story. We're talking a drop from a jaw-dropping 14% growth back in 2007 down to a target of around 5% today. Now, 5% sounds great for most countries, but for China, that's the lowest it's been in decades. And this isn't just a post-pandemic blip. It's a fundamental structural slowdown. The end of an era, really.
So, to really get our heads around this, we're going to break it down into 5 parts. Think of it like a doctor's checkup for an economy. We'll look at the symptoms, find the core problems, check out the treatment plan, see how it feels on the ground, and then talk about what's next.
All right, first up, how did we even get here? For decades, China's economy ran on a super simple, super effective formula. Build, build, build. And man, did it work. For a while.
Here's a great way to picture it. Think of China's economy as this massive rocket. The fuel for that rocket? Gigantic investments in property and infrastructure. I mean, it delivered an incredible, historic liftoff, pulling hundreds of millions of people out of poverty. But here's the catch. That fuel tank is now running on empty, and the rocket is starting to lose altitude.
And the reason that fuel ran out comes down to this really fundamental imbalance. If you look at China's GDP, only about 39% comes from people like you and me actually buying stuff, household consumption. Compare that to the global average of around 60%. It's way off. Instead, a huge 41% came from investment, building things. This is what led to, well, building way too much of everything, especially apartments. You've all seen the pictures of those ghost cities, right? This is why.
Okay, so that old model has left behind some serious problems. We're going to call them the 6 core frictions. Think of them as cracks in the foundation that are now acting like brakes on the whole economy. And what's really important to get is how they all connect and feed into each other. It's a complex web.
So what are these 6 frictions? We've got the property bust, this massive pile of local government debt, the looming threat of deflation, scary high youth unemployment, trade tensions from having too much stuff to sell, and finally, what we're calling policy handcuffs, which basically means Beijing's hands are tied. Let's dig into each one.
All right, first and biggest one, the property bust. This whole thing really exploded back in 2020. The government got spooked by a potential bubble and slammed on the brakes with a policy called the 3 red lines. It basically put a strict cap on how much debt developers could take on. For huge companies like Evergrande, well, it was game over.
And the fallout? It's been staggering. In big cities like Beijing and Shanghai, property prices have plunged by 30, even 40%. Now, just imagine this. Nearly 70% of the average Chinese family's entire net worth is tied up in their apartment. So when prices fall that much, it's not just a number on a screen. It's a reverse wealth effect. People feel poorer, so they stop spending. They just shut their wallets.
Next up, we have a mountain of debt, but this time it belongs to local governments. You see, for years, Beijing pushed these local officials to hit these crazy high GDP growth targets. And to make that happen, they funded all sorts of projects using these special, kind of shady, off-the-books companies. They're called local government financing vehicles, or LGFVs. The business model was simple, really. They'd borrow a ton of money to build roads, bridges, you name it. And their plan to pay it all back was to sell land to property developers. A pretty sweet deal when the property market was booming. But when that market collapsed, so did their main source of income, and they were left holding the bag, a bag with over 7.8 trillion euros in debt.
The third friction is something that sounds good on the surface. Deflation. That means falling prices. Cheaper stuff, right? Who wouldn't want that? Well, for an economy, it's actually incredibly dangerous. It's a giant red flag that demand inside the country is just incredibly weak. This leads to a sneaky problem called weak nominal growth. What that means is, even if the official GDP number looks sorta okay, the actual amount of money, the nominal yuan, flowing into people's wages, company profits, and government taxes is flat or even falling. Think about it. If you expect your new TV to be cheaper next month, you're just gonna wait, right? Now imagine millions of people doing that for everything. The whole economy just seizes up. At the very same time, you've got this huge mismatch in the job market.
China is pumping out a record number of university graduates, which is great, but the white-collar service jobs they were hoping for, they're just not there. The real growth is in high-tech manufacturing, and that requires a totally different set of skills. And the result is a youth unemployment rate of 17%. Let that sink in. That's nearly 1 in every 5 young people without a job. This is a huge deal. It crushes confidence, it kills spending, and it creates some really tough social challenges down the road. And here's a first knowledge gap for you to think about. How is China's shrinking and aging population going to affect its ability to innovate and consume over the next decade?
So, with people not buying much at home, what does China do? It does what it's always done best. It exports. It's basically pushing its surplus goods, especially green tech, out onto the global market. And this has kicked off some absolutely brutal price wars for things like electric cars and solar panels. And no surprise, this is leading to major trade tensions and new tariffs from places like the US and Europe.
And that brings us to our final friction, the policy handcuffs. You might be thinking, with all these problems, why doesn't Beijing just fire up the stimulus machine like they always do? Well, the simple answer is they can't. Their options are now surprisingly limited. Which brings us to Beijing's delicate balancing act. They are very deliberately trying to use precision tools here, not a giant stimulus bazooka. They're caught in a classic trap. If they stimulate too much, they risk their currency taking a nosedive or just creating even more bad debt. But if they stimulate too little, they could fall into that deflationary spiral where no one has the confidence to spend or invest. That's why they're trying to act more like a surgeon with a scalpel, making targeted cuts rather than just blasting the economy with cash. Okay, so we've talked about all this high-level economic stuff, but what does it actually feel like for the people and businesses living through it every day? Well, if you had to sum it up in one word, it would be caution. Yeah, everyone is playing it safe, from the very top to the very bottom. You've got households putting off big purchases like cars or new appliances and just hoarding cash instead. You have businesses getting squeezed by those price wars we talked about, destroying their profit margins. Banks, they're getting nervous, only lending to the absolute safest projects. And the property developers are just trying to finish the apartments they've already sold, not even thinking about starting new ones. And that leads to a second knowledge gap for you. What are these new productive forces that Beijing is hoping will power the next wave of growth? All right, so where does China go from here? And maybe more importantly, why does any of this matter to the rest of us? Let's look at the possible paths forward. Most experts see 3 main scenarios playing out. The most likely path is what they're calling muddle-through. Basically, slow, bumpy progress with mixed results. The pessimistic, or bear case, is a kind of Japanification-lite, where deflation sticks around for a long time. And the optimistic, or bull case, would involve a much bigger, bolder policy push from Beijing. Now, for the rest of the world, this all has real consequences. It means things like cheaper EVs and solar panels for sure, but it also means weaker demand for things like oil and iron ore, and continued pressure on global companies to move their supply chains out of China. So at the end of the day, this isn't really a story about an imminent collapse. It's more of a managed, slow-motion adjustment that's going to take years to play out. China is literally trying to swap out its entire economic engine in mid-flight. And that leaves us with the one huge question that's going to shape the global economy for the next decade. Can they actually pull it off?